I'm really excited to talk about this today. I'm also going to follow suit and just pitch you a single paper that I've been working on right now. So I write a lot about municipal bonds. These are the main instrument in the US by which state, local, cities, school districts, they're going to invest in durable public assets. It's a really, really big market, and it is one of the key ways in which we're going to invest in the US in climate resiliency and in lowering greenhouse gas emissions. So I think this market's important. It's about a $4 trillion market. To give you a size, so not as big as the mortgage market, but it's a pretty big market. It's going to finance basically any time that there's a new school building or a new water system or a new public asset that is built, a new courthouse, whatever, is going to be financed with a municipal bond. And so if we think this is one of the core ways in which we're going to be investing in climate resilience and in lowering greenhouse gas emissions, we would expect this to be a very, very common place for green bonds to exist. But if we actually look at, so one of the things that will happen when you're issuing a bond, which is of course a promise to pay investors who are going to give you cash to invest in the asset you want to build, lots of these are going toward kind of green projects, but the self-labeling of green bonds is quite rare. So if we look in the data, about 4.5% of the funding raised in 2022 was issued as a self-labeled green bond. And there are a few more sustainability bonds and a few more social bonds, but it's still not a very big portion of the market. So we're wondering, is climate investment not happening? Or are there reasons in the financial market why we might not be labeling our debt as green? Is it because investors don't care about the greenness of their bonds? So one of the things that we noticed when we started looking through these green bonds is that they're really issued primarily in the richest places in the US, that it's mostly kind of California and New York where we see green bonds being issued. And there is some evidence that they receive favorable pricing. And so I want to ask first, why don't others issue green bonds? And maybe are there no related projects that they're investing in? Are there political constraints? Are there financial constraints? Is it the fact that just nobody cares about these bonds? So what makes that tricky is the bonds are being used to finance all sorts of different projects. But so what happened last year in March that has been very lucky is that there's a nice natural experiment in that Bloomberg started listing for about 127,000 bonds around the US what the relative ESG characteristics of these bonds are. And then particularly what was important is they wound up giving a official verified opinion on whether the bond would be a green bond, a sustainability bond, or a social bond. And so I'll just kind of show you what this looks like on Bloomberg. I know it's kind of small, but bear with me. In the far left column, we see little green leaves on Bloomberg. This means that the bond self-verified as a green bond. And so we can see here in this sample of bonds I'm showing you, 3 of them have been verified as green bonds, one of which is this California Community Choice Financing Authority. What happened on March 6th of 2023 is they added this column here, and actually a few other columns on the right, about the ESG characteristics of these bonds. And what we can see is, essentially, this is not exact, but it's close, that about above a 4 is going to be would qualify as a green or sustainability bond, below a 4 wouldn't. And so what we can see is, yes, that California Community Choice Financing Authority, it's going to be a community college financing authority. Yes, it would have qualified as a green bond under this new Bloomberg measure. But the other Mount San Antonio Community College District just above it also issued a bond that qualifies as a green bond by international standards, that is being used to engage in climate resilience and greenhouse gas emissions. It scores very highly, but it wasn't self-selected as a green bond. And so what I'm going to do is I'm going to engage in a very classic, what we call it a difference in difference analysis, where I'm going to compare the pricing of the bonds that self-labeled as green, and I'm going to compare that to the pricing of the bonds that didn't self-label as green, but then became verified as green through this process. And so what I can see is basically, first, did investors care and are they willing to pay more for these sort of green bonds? So I'm going to compare this Mount San Antonio bond to the California Community Choice Bond, which was already labeled as green, and say, what happens? And so this is I'm going to show you from 2021 to 2023. I'm going to show you the spreads relative to a maturity matched treasury. And so this is a measurement of how much does it cost a municipality to raise financing for their projects. And so we can see within bond that these green bonds that I'm going to call ex post green and sustainability bonds, so from the end we see they were green and sustainable. They had differential pricing that I'm going to difference out. Then Bloomberg started selling this information to some select institutional investors. And then on March, when they started announcing this information, we can see a robust 3 basis point increase in decrease in the spread, or a premium that investors are willing to pay for these bonds relative to other bonds. So we see investors do care about this information. They particularly care about it for green and sustainability bonds. I'll highlight, we can also show the same thing for just social bonds that don't have any climate impact. And we don't actually find the same impact here. So it seems that investors really do care about the climate impact and not just kind of some broad, ambiguous ESG characteristic, but they really, really care about the climate impact. And as a final kind of interesting puzzle, many of these bonds that would qualify as green or sustainable or social are also issued by relatively rich and credit-worthy places. Somewhat weirdly, one of the largest beneficiaries, or the largest beneficiary we're able to find of this additional information that Bloomberg reported, is bonds that don't qualify as green bonds or sustainability bonds or social bonds, but that get information and didn't have a good credit rating. So low credit rating issuers seem to find this information and show that it has, it's very complementary to something about credit risk. So here I'm going to show different bonds. The blue line is the one I want you to look at. This is bonds that don't qualify as green bonds, that have low credit ratings, and Bloomberg comes out and announces, hey, this doesn't qualify as a green bond. That announcement of information seems to lead to much more beneficial pricing for these bonds and lower borrowing costs in an order of magnitude of about 12 basis points. So I think we're finding that investors do care about the greenness of their bonds, and not just for the bonds that actually qualify as green bonds under some international standard, but that this disclosure is very, very important for being seen as complementary to other material considerations about the creditworthiness of the borrowers. So thank you so much for your time. I'll pass it on.